What is market economy? A market economy is an economic system in which the production and distribution of goods and services are guided by the interactions of buyers and sellers in a market, rather than by central planning or government intervention. In a market economy, prices are determined by the forces of supply and demand, and producers and consumers are free to make their own economic decisions. In a market economy, individuals and businesses are free to produce and sell the goods and services they choose, and consumers are free to buy the goods and services they want. This system is based on the idea that competition among producers will lead to the most efficient use of resources and the lowest prices for consumers. A market economy is contrasted with a planned economy, in which the government plays a more active role in directing the production and distribution of goods and services. Market economies are also sometimes referred to as capitalist economies, because they are based on the principles of capitalism, which emphasize private ownership and the pursuit of profit. What is a capital market? A capital market is a financial market that is used to raise capital by selling securities to investors. Capital markets include both primary markets, where new securities are issued and sold to investors, and secondary markets, where existing securities are bought and sold among investors. The main purpose of capital markets is to provide a way for businesses, governments, and other organizations to raise long-term financing. This can include raising money for expansion, funding new projects, or refinancing existing debt. Capital markets can also provide investors with the opportunity to earn a return on their investment through the sale of securities such as stocks, bonds, and other financial instruments. There are two main types of capital markets: the equity market and the debt market. The equity market is used to raise capital by issuing stocks, which represent ownership in a company. The debt market is used to raise capital by issuing bonds, which represent a loan made to a company or government. Capital markets are an important source of financing for businesses, governments, and other organizations, and they play a critical role in the functioning of the global economy. What is debt market? The debt market is a financial market that is used to raise capital by selling securities that represent debt. These securities, called bonds, are issued by businesses, governments, and other organizations as a way to raise money to finance their operations. In the debt market, investors lend money to the issuer of the bond in exchange for a promise to be repaid with interest at a later date. The interest rate that is paid on the bond is determined by the creditworthiness of the issuer and the current market conditions. Higher creditworthiness typically leads to a lower interest rate, while lower creditworthiness typically leads to a higher interest rate. The debt market is an important source of financing for businesses, governments, and other organizations. It is also a key component of the global financial system, as it allows investors to earn a return on their investment by lending money to companies and governments. The debt market is typically divided into two main segments: the primary market, where new bonds are issued, and the secondary market, where existing bonds are bought and sold among investors. What is equity market? The equity market is a financial market that is used to raise capital by selling securities that represent ownership in a company. These securities, called stocks or shares, are issued by businesses as a way to raise money to finance their operations. In the equity market, investors buy shares of a company in exchange for an ownership stake in the company. The value of a company's shares is determined by the market, and it can rise or fall based on various factors, including the company's financial performance, the overall state of the economy, and investor sentiment. The equity market is an important source of financing for businesses, and it is also a key component of the global financial system. It allows investors to earn a return on their investment by buying shares in companies that they believe will perform well. The equity market is typically divided into two main segments: the primary market, where new shares are issued, and the secondary market, where existing shares are bought and sold among investors.